Okay, I think we'll go ahead and get started. Well, good morning, everyone, and thank you for joining us for ETF BILD's first panel discussion of 2023. We've got a great panel ahead of us today. Very excited about it to kick the year off this way. As some of you may have picked up on from our invitation, we're doing a little different format today. It's going to be rapid fire questions through many topics. We think it'll be very efficient. We're calling it an homage to ESPN's Pardon the Interruption, and we'll give Bib credit for coming up with this concept for us. Before we dive in, however, some quick background, some quick introductions. Presumably those of you on this call, on this webinar, already have some familiarity with ETF BILD. I'll just mention, I was pleasantly surprised and stunned when I went back to check that this is the 6th year of ETF BILD, which the four of us formed in order to sort of find a new vehicle for some additional discussions around the ETF industry and try to be a catalyst to talk about some of the things that maybe are not often talked about, particularly the business side of ETFs, and just create a forum for that. So we're really excited to be part of that and have that continue now into our 6th year. So with that, we'll do some quick introductions. I'm Justin Mize. I'm one of the 4 co-founders of ETF BILD. We'll do quick introductions here. Let's go Bib, Rich, and John before we set up for the first topics. Bib, if you wouldn't mind.
Yeah, thanks, Justin. Bib Strench. I'm a partner at Thompson Hine in their Washington, D.C. office. And I started my career at the SEC when the first application for a ETF came in. So I've been involved with ETFs my entire career.
Thanks, Bib. And Rich?
You're still muted, Rich.
It's a management consulting firm that helps folks launch ETFs and other financial products. I also work with a lot of fintech companies and indexes as well to help them bring products to market. I started my career as an equity block trader. Then I moved over and worked for NASDAQ for a number of years, where I created their ETF listings business, and then I started Global ETF Advisors about 13 years ago now. And obviously a co-founder of ETF BILD.
Thanks, Rich. And John?
Thanks, Justin. So John Jacobs, spent many, many years at NASDAQ, got into the ETF business in '98 as I started to develop this product we were calling the NASDAQ Spider, which turned into QQQ, which we launched in '99. So I spent many years building out that index and data business. Retired from NASDAQ in 2016. Spent 5 years running the Center for Financial Markets and Policy at Georgetown. I currently serve on a variety of ETF boards, work with index and data companies like Verify. Also do a lot of stuff in the blockchain space. So kind of keeping a couple different areas. So and Justin, to your point about the 6 years of ETF BILD, I remember one of the reasons we started this whole thing was we thought, well, there's such concentration in the industry between asset managers and indexers that, you know, our goal was, let's surface some issues that may not get surfaced with, you know, high concentrations. And I find that the concentration is still the same, but even more importantly, I think now we're seeing a real concentration in market participants, where a handful of market participants are doing also providing most of the liquidity and trading and et cetera into ETFs. So I think our role is more important than ever in trying to, again, bring to the forefront some issues and questions that, you know, may not get surfaced by the traditional route. So anyway, it's been a pleasure working with you for the 3 of you for these past 4 years, so 6 years.
Yeah, thanks, John. Obviously, feelings mutual, and I should probably just mention a little bit about my background as well. So I'm the founder and owner of Buttonwood Communications Group. We're a financial services PR firm, but I think more relevant to this discussion, ETF BILD. I have worked on ETFs from a PR, marketing, communication standpoint. My first brush with ETFs was actually select sector spiders back in the early to mid 90s, which, by the way, I mean, I wish I could say that ETF BILD was this smart. We timed this discussion for just a day or two after the 30th anniversary of the first ETF. Obviously the Spider, which everyone's, you know, very familiar with the anniversary this week. But it is remarkable to think it's 30 years, and I think everyone on this call, and certainly probably most people that are joining to watch this live or in replay, likewise, their careers have been shaped and they've been participants in shaping the ETF industry over maybe all of those 30 years, if not most of it, you know.
Yeah, I think it's and Justin, just putting off that 30 years from the launch of the Spider, I think we remiss if we didn't just reflect upon, you know, the loss of Kathleen Moriarty recently. Kathleen, obviously, the Spider woman who helped get that first ETF through, and then is to her last week of her life was still working on ETFs as trust counsel for ETF boards, et cetera. I first met her during the developing the Q's project, et cetera, and she, you know, worked with her on multiple different projects, and I know every one of us feels a profound sense of loss. She was absolutely a pioneer of the ETF industry. We wouldn't all be here today if it wasn't for her. So I thought it would be remiss if we didn't reflect and just think about Kathleen for a moment. And so, Justin, I'll turn it back to you, Jack.
Okay,
Tell us
well,
where you want us to go. Where do you want us to go?
Thank you for those comments, John. Well appreciated. Before we dive into the first topic, I just want to let everyone know, because we're going rapid fire, I know usually on a panel discussion, we tell everyone, send us your questions. We got some at the end. I think for most questions today, we'll probably take them on the fly. So as we're moving through different topics, if you have a question, just you can just type it into the box there. It'll come right to me, and then I'll pick spots as we move through to try to hit them on the fly, or if there's some at the end, we may come back to those too. So maybe let me start by saying this. We're talking about 30 years of ETFs. I think the industry, it's a easy comment to make that it's a little different now in launching an ETF than it was in the early 90s when nobody knew what the heck an ETF was. So Rich, let me start with you, give you the floor. Talk to us about getting product out. Where are we on this today? What do you see coming?
Yeah, and then let me start with this, just to dive back into the SPY and Kathleen, and bring it back into getting product out. What all this kind of all relates to is sort of innovation and entrepreneurship, right? And this is where it all began. And the whole ETF industry has been about innovation and continues to innovate. It's something I'm very passionate about. As a matter of fact, I'm a mentor at the University of North Carolina at Wilmington at their Center for Innovation and Entrepreneurship, and we mentor young entrepreneurs to get their businesses and their product out the door. So this is a big topic, and it's really a turning point of our economy, right? That we got all these entrepreneurs and new businesses starting. So in the ETF space, it's been a rapid discussion. It's also been rapid change. Product now is coming out on the market faster than ever due to regulatory issues, right? We have the ETF rule, access to capital. And the demand for the ETF product is all helping to get product out the door a lot faster. As a quick example, back in 2015, we had about 285 launches. Last year, we had 431 ETF launches. We even launched over 300 in 2020 in the middle of the pandemic, right? So getting product out the door is happening very quickly. The vendors are getting more competitive, so it's cheaper to get out the door. And we're just seeing this proliferation of product, and then we'll get into this later on. It's like, okay, now what product do you bring out? Where do you fit into the shelf in order to build a successful ETF? So getting out the door is easy. It's what you do once you're out the door. It's the post-launch issues about distribution and other things to get the product out the market. But getting product out the market can get done easily these days.
Yeah. So as you say, Rich, so that's the bigger battle now is probably what happens after the fact, right? We often, for years, we've talked about the economics of an ETF once it launches. Where are we now, in your view, with the sort of the break even on AUM? And has it been rising? And what do you anticipate this year and beyond?
Yeah, so it's been coming down. Again, a lot of it is due to vendor costs, the proliferation of white labels, and shared trusts. So people can get out to market quickly and a little bit more efficiently and operationally efficient by leasing other people's services. And if you want to start your own trust, and then you got a higher level. But ballparking it in the middle of those sort of three ways of coming to the market: the shared trust, a white label, or on your own, it's going to be somewhere in the neighborhood of about $300,000 a year before. Just for the ETF trust. And again, the variable there is what product and what is your management fee, right? If you're trying to compete in a low margin area, you're going to have a much higher break-even point. So those break-even points can go anywhere from 50 to 75 to 100 million, depending on all those different variables.
That's great, Rich.
I will add real quickly that one thing has happened is obviously ETFs are almost always unitary fees, so the advisor ends up paying the cost of the service providers, and the service provider costs have risen because of regulatory issues. Most recently, the derivatives rule, the service providers are having to outsource themselves. So that's impacting, what that break even AUM is in the last couple of years.
Yeah, it's definitely not cheaper to launch an ETF today. And so, Rich, comment on this, because I think this is something that I always focus on. And going back in time, I mean, I launched the Qs with less than $15 million in seed capital first day. And then, Susquehanna popped in another 135 million in 5 business days. But that was a different time, different models, tape revenues, all sorts of different reasons, and products were successful. I think seed capital is far more important today for products. I mean, you can launch a product with a large seed capital. That's not going to guarantee success. But if you launch with a little bit of seed capital, it's really, really hard to get to that break-even point. So I think seed capital is more important than ever. And unfortunately, one of the issues is that whoever provides seed capital for these products, a lot of them are taking on balance sheet risk, which is not in their models today, especially rising interest rates or anything else. So what do you think about the seed capital dilemma of new product launches?
Yeah, so there's also a shift there, right? So as you mentioned back in the day, you got Susquehanna, you got your lead market makers, back in 06 to 010, they were putting in 10, 15, 25 million per ETF. Now you're lucky if you get $1.5 million out of it, right? Because the trading business has changed. The ability to make money as a market maker, the risk that you take as a market maker has really squeezed the market makers. So that cost to carry for them now is quite expensive. And what ETF providers and new ETF providers who are coming to market are doing is they're bringing in seed capital from their clients or from their parent company, not from the market making community. They'll get the statutory seed capital, get the first shares in the market from the market makers. But in order to get visibility to the advisor community and to the investor community by having volume, trading, and assets, they have to bring an outside seed provider who's gonna invest in that fund on the first few days of trading. And that's where we're seeing some of these launches at 25, 30 million. And then we're going to talk about this later, but then you also have mutual fund conversions, SMA conversions that come in with automatic AUM. So there's a lot of product coming to market that way. So there's different ways to come into market with seed capital. But coming from the market making community, that's become very, very difficult because of the nature of the business these days.
Yeah. No, thank you all for that. And let me key off of that with our first stop by the mailbag. We actually have a question from the audience, so thank you for that. And it's really about all these products coming to market. I think Rich maybe keyed off of, as you were pointing out, the increase in the number of launches we're having year over year, over several years. The question is, isn't the market oversaturated? I mean, we've talked about this before. I'm not sure who wants to kind of kick us off.
Yeah, I'll jump in on that real quick, just because I think the kind of in rapid fire, we don't go into details here, but the demand for the ETF product is going to be the first thing that drives this. Why is there a proliferation of product? It's because there's people willing to buy the product. You have customers, and we're nobody's trying to compete when they're bringing out new product. They're not trying to compete with iShares and Vanguard and State Street. They're not looking at that as competition. They're looking at breaking this market down into segments, and we'll get into that a little bit when we talk about thematics. But there's different ways to enter the market with different types of products for different types of clients. And people are selling ETFs just to their client base, not necessarily to every single ETF provider. If you look at the mutual fund community, there's 8,000 mutual funds out there before the ETF industry even started. So there's a model there that says the market can hold this amount of products without too many issues.
Yeah, I agree with Rich 100%. I think that launching products today is about the channels as much as it is about anything else and targeted distribution. So again, it's not necessarily trying to compete with the big three firms, et cetera, but you're finding your customers delivering a product or strategy to them in the ETF wrapper that they want in the way they want it. So I sort of think the market's oversaturated. And by the way, in the last 30 years or 25 years, I've heard many times, well, we're done now. All the ETFs out there, they're going to be out there. We're saturated, et cetera. And we still seem to have a lot of successful products that come out there. A lot of them don't make it. Several don't make it. And Rich, that's the flip side. I was going to ask your thoughts on the flip side of that is, what's the biggest reason you see new products fail?
I guess there's a couple of reasons. One is sort of, again, misreading the demand for your product. Not having the proper distribution infrastructure to be able to sell your product. And then lastly, you don't have enough capital to keep the ETF running to do all the things you need to do. It's expensive, and you have a 3-year run before you see the return on capital. So you have to, what I always call, you have to have patient capital in order to keep that ETF up and running.
What I've observed is that the kind of the old model where you have wholesalers calling on financial advisors and your product is somewhat generic. Let's say it's a great fixed income product. There's some strong headwinds there, and it seems like there's more of a shift to digital marketing and alternative marketing, and less, especially for new entrants, using the old wholesale market.
Yeah, and actually, Justin, I'm going to throw this back at you for a quick second, because based on what Bibb said, this use of digital marketing that we're doing, and we talk about this all the time with our entrepreneurs. You have to be a storyteller. You have to have a story, and you have to be able to tell it. And that's where the PR side of it comes in, and helping people craft that story and get that story out. So that's sort of your wheelhouse. So if you want to talk about that for a minute.
Yeah, I'll just do maybe. I mean, like a lot of these topics, we could spend an hour on any of these, I think. On the PR side and the storytelling side, Rich, yeah, thanks for throwing that my way. I would just say, a lot of what we talk about from a launch, from a sales perspective, applies to the PR side. I mean, do we really understand the audience this product is for? And did we read that audience correctly? And then I think it's really about making sure we understand the value proposition for that audience, and can we articulate it in a really tight, succinct way? We see it all the time with whether it's an ETF or any other kind of financial product. One of the big mistakes that investment managers make is they build a better mousetrap. They have something that's really incredible, but they can't tell the story in a simple way and get to what the real benefit is to the end user. So a lot of times we encounter clients are working with, they have a product that's just like incredible, amazing innovation, but it's such a convoluted story, and the story is too involved, too complicated, it's hard. And that's true for the advisor community as well, because we have to get the advisors to get on board with it in most cases, and then they need a simple way to convey that to the investors. So it really does come back to the basics of just good fundamental value proposition, planning that, messaging around it, good storytelling to that too. And like I said, that could be an hour on its own. John, looks like you want to jump in.
Yeah, I was going to say, because it's exactly right. It's telling the right story to the right audience in the right way. And we all go back and think about this. It's not just ETFs. Steve Jobs stands up and with the first time iPod, he stands and goes, 10,000 songs in your pocket. Okay, understand that concept, pretty straightforward. Apple wasn't the first MP3 player, the iPod, or when he stands up the first iPhone, the internet in your hand. These are simple concepts told to the right audience in the right way, and so that's what you have to do. So I agree. We've all seen countless stories of the better idea, the better mousetrap, but they're not telling the story the right way or to the right audience. So.
Yeah, no, thank you, John. And I'll just say, just to remind everybody, a lot of things we're talking about too, ETF BILD is written about. You can get on the website, or likewise, just send any one of us a note, and we'd be happy to pull some of the things we've written about these topics and get them over to you. I don't think we've written on every topic we're hitting today. We're hitting quite a few. But we have quite in there. Back to the mailbag real quick. Question from the audience. What do you think is the appropriate level for, quote, patient capital?
Yeah, that's interesting. So it's a moving target. But let's just use that number, $300,000 a year with no assets to make your ETF trust break even. right? So then you're looking at 3-year run rate for most ETFs before you start to see the return. So you're looking at least $1 million minimum just for your ETF trust. Now, you're going to have more capital on hand because now you have to do marketing and sales and pay salaries, and you need money for all that as well. That $2 to $3 million range for 3 years is sort of kind of the sweet spot.
That's great. Thanks, Rich. I'm watching the clock. I'm going to get back to more rapid fire. John, let me go back over to you. Rich has brought up thematic ETFs. What are your thoughts on thematics right now?
I still think they roll in and out of favor. I think they fit a part of the marketplace. Remember, you have broad indexes, thematics, which is a sector or a theme, and then individual stocks. Each one of them entails their own return and risk and volatility kinds of opportunities, et cetera. So, we've just seen this past market, it's really tough to be in broad indexes, and we've seen, the moves for the last couple of years, et cetera, on broad indexes and index investors, et cetera. And at the same time, picking individual stocks is just very risky as well. So thematics kind of fit that block in between. So I still think there's a huge runway for thematics. I think it's very important. I think they really fit a need with a lot of individual and smaller investors. I also think the important thing about thematics is it makes it easier to kind of rebalance your portfolio and relook at it, right? And we talked about this is from back to select sector spiders. You could, you want to heavy up one sector and lighten up. It's a simple trade going in and out with these baskets that reflect a theme. Is every theme well explained, or there's too many themes out there, or too many different strategies? Again, this goes back to, is it the right strategy? Are you telling the story correctly? Does it do what it says it's going to do? And I think we'll get to that with when Bib talks about some of the SEC issues. But I'm not sure everyone, so some of these themes, thematic ETFs people are investing in, are actually doing what they think they're doing, or doing it the way they think they're doing it. But I think thematics are an important part of the ecosystem. I think they're here to stay, and I think we're going to see more and more offerings of that type, especially with digital, complemented with digital distribution, which allows you to target. In the old days, you said, I want to reach the soccer mom driving a minivan. Well, now you want to reach a soccer mom driving a minivan. It's a Honda Odyssey with 2.3 kids that's living in a suburb of Georgia that wants to invest in this. And so you can get much, much more granular with your targeting distribution. And therefore you can try to go back to, as we said, tell the right story to the right audience in the right way.
John, go ahead. Sorry.
I just real quick. The other side of the thematic thing is one is your own intellectual property and bringing your intellectual property to market. That's where you can set differentiation, and if you have research behind that, it's great. But from a business standpoint, it's also where you can charge higher fees. That's the hard part of getting into the ETF industry, is because there is such fee compression on those broad market products, that coming into the market with a new thematic with your own IP, you have a chance to get some pricing power for that. And that's why I think you're seeing a lot of thematics come to the market, because that's one way to enter the market with some margins, and the other way would be through actively managed products as well.
That's great.
One thing to note too is that when you're making that decision, there's been more and more ETFs that are actively managed, and you're seeing that somewhat in the thematics. But nevertheless, considering going with an index approach, which number one kind of locks in what John is saying, you have a methodology that you're following in a pure product, and then to their benefits as well. If you've got the intellectual property in the index, or you co-develop it, you may be able to license that IP as well.
Let's go to a new topic, and let me start with John, but then go over to Bib on it, because I think that's going to flow nicely into that. So, John, we're seeing this trend of floor listings. Can you talk about what's behind the trend, and what else do we expect to see there?
Sure. So, as a 30-plus year NASDAQ veteran, I love talking about the floor. So, anyway, no, but I think the floor. So, I've watched this, the PIMCO bond fund that they moved over, et cetera. I think it ties directly to what we were just talking about. As you come up with either more actively managed products or products that aren't on, the original idea was, let's go to the floor, because the floor will be a combination, a hybrid of digital and human, to allow for better quality of markets. And that will include everything from enhanced liquidity to reduce volatility and trading costs and improve price determination. I think it's less, I think it still goes back to, in certain cases, it's not just because a lot of people make the comparison, well, it's a index ETFs don't need the floor. Well, it's not whether it's an index or not, it's whether or not the underlying constituents are liquid or not. So it goes back to liquidity in many ways. And I think that the NYSE, our friends at the NYSE, reintroducing ETFs to the actual floor as opposed to the electronic segment, are trying to do exactly that. They're trying to provide a human touch to focus on actively managed or more challenging products of trade to very simply better quality of market, increase liquidity, and to attract investors. They'll talk about attracting global investors, but I think just investors in general. So I do see it as the marketplace's answer, one of the marketplace's answer, and there's no one answer to this, to continually striving to get better quality markets. Your spiders and Qs, liquidity is liquid. You've got that, right? But for other products on the spectrum, the enhanced liquidity program, the ETF liquidity provider program, the offerings, these are all things that the marketplace and the markets are trying to bring to increase liquidity and better quality of markets for products. And I think it's really, but just, again, there's no one size fits all.
Yeah, and I'll just throw one little statistic out there for you to understand the scope of this issue, right? You have over 40% of current ETF issuers, based on the ETF.com leagues table, that are under $100 million in assets, and most of them are under $50 million in assets. So that's a whole lot of ETFs out there that aren't trading. And how do we get them to trade? That's a big issue. Trading illiquid stocks has been a challenge for the SEC and stock exchanges for years on how to incentivize market makers to trade that. And I think the special system is probably one of the better solutions. And again, an old NASDAQ guy saying this, it kind of hurts, but I think it's the truth. That special system for low liquidity products is the best system for these types of securities.
And we could spend hours talking about this particular topic, but it also goes back to this is not just an ETF problem. This is a small public company problem, right? Small public companies really have a challenge. And without dating myself too much, when we all moved to decimalization back in the day, and we moved to and changed some of the trading rules, and essentially every market's now electronic. One of the things that they treated all securities the same, whether you're Microsoft or QQQ, or we are a very thinly traded ETF or a small community bank, you had this new market making system or a new market system that was decimalized. You didn't have to require two-sided quotes and depth of market and all those kinds of things. And it works fine for liquid securities. It does not work fine for illiquid securities. And it's an issue that a lot of us have asked the SEC to look at and address over the past 20 years. And I still think it's even more important today. So it is an issue that the markets are designed for speed and liquidity. And if you're not a fast, very liquid security, it just poses more problems.
And a couple of quick points. So this is very recent, and besides PIMCO, there are smaller ETF providers taking advantage of this. The New York Stock Exchange got their rule through the SEC to permit this. One of the conditions, interestingly, that the SEC imposed is they went back to the old generic listing requirements and added a diversification requirement on the portfolio, which is not currently in place for ETFs listed on NYSE Arca. So there was motivation behind that, but just something to be aware of.
Hey, and Bib, I was going to move to another topic and start with you. Before I do that, another mailbag question that was directed towards you. Could you elaborate a little more on the copywriting, the IP topic you were talking about a little while ago?
Well, I can, yeah, from a legal side, obviously in index methodologies are proprietary information, and you have a right to that, and you have the ability to license that, and it can be, for an SMA product or a hedge fund product, so it can be another source of revenue. But I don't know if you have anything to add, John, with your experiences at VetaFlag.
Sure, or where you said NASDAQ. So you license if you license an index or a strategy, you're licensing the methodology. You also license the trademarks, and you have the power everywhere. We all know that the Dow Jones Industrial Average is, the 30 stocks they pick, blah, blah, blah. And people came up with the dogs of the Dow strategy. Well, you can't use dogs of the Dow strategy without still paying a license fee, because it is the dogs of the Dow, which is trademarked, and it is the reverse of their strategy of this. So, and it's very important. I think it's very important. And it not just extends to licensing for a product, but then you can get into licensing, which creates value added for the index data that falls out of that, or the strategy data, the constituents, when and where, and the weights, etc. So it is important that you, as you look at these, that you do protect and copyright your intellectual property.
As we go on the next topic, I'll just set this up. Rich, we'll probably start with you on mutual funds, the ETF conversions, but a lot of the back end of this, we're very bib loaded at the back end here. So
I'll
stick around.
There's going to be like a bib filibuster here, I think. And after Rich,
again, I'll try and do something that's very difficult for me, and that's to be brief. But to me, the mutual fund conversion is going to be the biggest trend in the ETF industry for the next 2 or 3 years. That transfer and how to get these big mutual fund complexes into the ETF space is important. And one of the driving factors is that when you look at these providers, these advisors, they want to be product agnostic for their clients. They've been having mutual funds and SMAs, but there's a great demand for ETFs. So they're feeling the need to at least offer some ETFs in the marketplace, so they can be diversified in their product offerings for clients and to grow new client bases. Right. So there's a big reason for that to do it from a business perspective. There's a couple of challenges in the what I call the decision tree and how to launch and convert a mutual fund and get it into the marketplace. Obviously, you want to do it in an actively managed format. And most of them that I have talked to, they really want the non-transparent to protect their portfolio manager's IP as much as they can. However, there's a challenge with the non-transparent type because the wirehouses are reluctant to let those products. They haven't been in the market long enough. They don't have enough liquidity in them. There's just a lot of risk currently. Now that could change over time. You can see a proliferation of it over time, right? But that's one of the biggest challenge. And there is, interesting enough, there is a new product coming to market or in the market now from a group called Blue Tractor, who's one of the first non-transparent platforms, where they're going to do a hybrid. Where you're going to be an actively managed fund until rebalance period where you go non-transparent. You can switch between transparent and non-transparent in order to help. So those are some of the challenges and the thoughts of that transfer. And now the biggest challenge of it all is going to be what Viv has to say about it.
And I think that challenge is less these days. When this idea was first floated, the big problem was that mutual fund shares are held at a transfer agent in the account holder's name, the shareholder's name, whereas ETFs, as we know, trade on the market and they're DTC. And so the thought and challenge was, how do you get his or her investment from a mutual fund account to a brokerage account? So that has been solved, and I think really operationally things are smoother. I will say this is one place where you need a plan. There are a lot of people involved in this, and one of the main reasons you need a plan in a realistic timeline is that you want this conversion to be tax-free. It's called an F reorg. And so you really have to drill down into all the different shares that are coming over from the mutual fund to the ETF. that's even more important too. Another trend, obviously, is taking your separately managed account business. Typically, you'll have, a couple hundred clients. They all own basically the same portfolio. That's another attractive conversion option where you can convert over to an ETF. And again, you want to be careful with the tax issues, so not to trigger any kind of tax on the actual transaction. But yeah, like Rich says, this trend is going to continue.
And Bill, what about with, in general, the additional costs of doing that transfer, right? Because we talked about a basic break-even point for launching a new ETF. Now, what kind of percentage, or how much higher does that go with this additional legal work that needs to be done?
Yeah, well, I think one thing is it can all stay in the same family, so a lot of your costs probably will be the same. Traditionally, mutual fund transfer agency costs are higher than ETFs really don't have that function because their shares are being obviously created through the create redeem process. So I think there are savings going the ETF route that the advisor may see. And if you don't have a unitary fee, you have a traditional asset under management fee, you can continue that with the ETF. So your fee doesn't have to be impacted.
Yeah, and I think again, if you look at the projected growth of AUM, the ETF industry, this is what I'll call artificial growth, where you're going to get these transfer of assets from the mutual fund industry into the ETF industry, something we've been talking about for the last 15, 20, 30 years in the ETF industry. Like, when is this going to happen? And it's happening, right? And this is something we've always asked for and wanted in the ETF industry as we built this industry out. And now we're at this point in time where we're going to start to see some real hard assets being moved over into the ETF space. So it's kind of a very exciting process that we've worked our way through as an industry, and it's going to be an ongoing trend.
Great. Watching the clock here, we're down about 6-7 minutes. So, Bib, let me jump back to you and let's talk ESG. It's an easy topic. It's everything's going smoothly.
Yeah. Well, yeah, and I'll talk about ESG and the names rule because they're related. And the latest proposals came out around the same time. And I think really the names rule has been a real challenge with this industry. We've been talking about innovation, thematics, and hanging over that is this dark cloud, the names rule. And it's been around. Its current rule is that 80% of the portfolio, must match the name. And it was a pretty tight requirement as to what that applied to, like equity or fixed income in your name. It was pretty easy to meet that 80% test. And as everybody knows, that the name can be critical, especially from a marketing point of view. And there are a lot of reasons to name an ETF a particular way. But even before this proposal, what has happened is the staff started looking at the investment strategy and saying beyond something like equity, the portfolio needs to match up 80% with the name. And the problem there, obviously, is it minimizes the flexibility of the advisor and the portfolio manager, even on a very basic level. If they want to go somewhat defensive, and they start hovering below that, that can be a problem. This new rule proposal would kind of codify what's been going on informally, and the SEC came up with this kind of real basic, vague standard that 80% would have to match what the name, what the names of the name is suggesting as with respect to the portfolio characteristics, meaning that now if you have growth or value in the name, international in the name, all of a sudden you're stuck with this 80% test. And if you violate it, the rule says you have to cure it within 30 days. And so the chilling effect is it may backfire kind of on the SEC because they'll leave out names like international in there so they can have that flexibility. And then from the marketing point of view, there's a negative there because you're not really describing your product that well. One kind of clever approach is to use your ticker symbol to try to get across what you're trying to convey, because that's not technically subject to the names rule. And then the ESG rule, I'll just say that proposal's still out. It's probably been out longer than people have expected, and who knows how that's eventually going to turn out. We have a new leadership in the House. They're getting more involved with the SEC. So I think it's kind of stay tuned on the ESG rule right now.
That's great, Bib. And down to just a couple of minutes, Bib, staying with you again, though, service provider rule. Can you just kind of walk us through where that is?
Yeah, and you can tell by this panel, the SEC has been very active, and that's one theme through 2023. They have a bunch more rules on the skids. And so what that rule is, it's an advisor rule, but as you know, all ETFs have a registered advisor picking their stocks. And the gist of it is that they're going to have to do due diligence virtually on all their service providers. And you can imagine the cost and consternation of a small ETF provider trying to get a large administrator or custodian to answer all these questions. And the SEC's even suggested that they need information about those large service providers, subcontractors. And so this one is probably number one in the last 5 years of negative comments. And most of the comments have not even come up with a solution. They've just said, do not adopt this. You have other rules that you can use to kind of go about ensuring advisors are doing the appropriate due diligence on their service providers. So we'll see what happens there. But as I mentioned earlier, the cost, the break even, this just elevates, if it passes, the cost of offering an ETF, because it's not only due diligence at the beginning, but you're going to have to monitor all your service providers.
Yeah, thanks, Bib. Down about a minute and a half left, so let me just leave the floor open for the whole build team here. Any last thoughts, either things we didn't get to that you want to make sure we cover, or any new thoughts for 2023 here, just to wrap up?
Yeah, I just one quick thing. Just want to thank Bib. Right, I think one of the great places where ETF build can have an influence and a value is finding our way through these regulatory challenges that we get. And as been said, this last couple of years has been an extraordinary amount of regulatory filings and changes that the SEC wants to make. So fighting our way through these as an industry is a battle sometimes. So it's great having somebody like Bib with us to help us work through that. And hopefully in the future, you'll see Bill come up with some more thoughtful pieces on these issues, and also comment letters to the SEC on various rule changes. We'll do that as well. I think that's a great place for ETF Build to add value.
And I'll just add, we're always interested in market structure. Sometimes it gets lost with talking about products. And there was a glitch yesterday with the New York Stock Exchange at the opening. And it showed the resilience. It was corrected quickly. Circuit breakers kicked in, and there was no disruption. But it is a product, and it is in an ecosystem and an environment. And you can't assume everything or anything. So I think especially with Chairman Gensler, market structure is probably going to be something that comes up more in 2023 and impact the ETF industry.
And ETFs came out of market structure issues. That was the birth of ETFs, was because of market structure issues.
Right.
Yep.
So it's interesting. And I give the exchanges a lot of credit for the way they handle these things. Their technology that they have built now to prevent these normal technology glitches that we see all day long. I mean, the airlines have them. They're in every industry. And to kind of reduce the impact of them is great. I remember back in the day in the early '90s, as a guy at Salomon Brothers put in a program trade in the wrong direction. He put in a sell order instead of a buy order, and it was a big order. It took the market down a little bit, but it was on the wrong side of the trade. So they had to cancel all those trades, put them back in as buy, and reprice everything. So we literally were trading for at least 2 days, not knowing the value of the S&P 500, and that was in the mid '90s. So those kinds of things can't happen anymore today because of what the exchanges have done, what market structure has done, to be as fair and as open as possible for everybody. And I think it's a tribute to our process here and to what the exchanges do. So kudos to them for limiting that issue.
So my last comment will be a kind of an extension of technology, thinking that one word that never came up once today that I think will come up later on this year extensively will be crypto, blockchain, ETFs. And I think this is going to be an interesting year to see what happens, because everything from FTX and all the other issues that we've had out there. So not for today, but I think more to come, that we will probably do a part of interruption on developments as they come down the pike. But I do think that 2023 will be a year that we do see some little clarity on this. So.
Yeah, and I think there's part and parcel to that too is the further development of AI, and the amount of new opportunities that that's going to bring and new ways to build products. So as always, with the ETF industry, to give access to new asset classes, to new ideas and new innovations. I don't think that's ever going to change, and I think our grandchildren's grandchildren will be talking about that as well. Right? This is an industry that was built on innovation and will continue to do so in the great future.
Yeah, careful, Rich, because the next one of these seminars will be done by ChatGPT 4.0, and then we won't even be here, and nobody will know. But
Right.
anyway,
that's okay. I live right near the beach, so I'm good.
Our Google assistants will all be on the webinar talking to each other. Great. Well, thanks everybody. Let's leave it there. We're a couple minutes over time. Once again, just thank you to everyone that logged in today to listen to the webinar, and those of you that may catch this in a replay later. We hope to see you at Exchange. If anyone's going to be down at Exchange, I'd love to connect you with you there. And please, we love feedback. So if you have any other questions for us, if you're looking for any other insights from some of the content we may have created already, or if you have ideas, as John was just saying, maybe a crypto panel is in ETF BILD's future. But any other kinds of panel discussions or experts you'd like us to help bring together to advance discussion in the ETF industry, please reach out. We love hearing from everybody. So with that, let's leave it there. Thank you to my esteemed colleagues from ETF BILD, and everybody have a great rest of the week.